You'd mentioned earlier that markets have been down this year. We're in a more difficult market than we've been in the last several years. And we have all this talk about recession on the horizon. With your background in financial services and investing, give us your sense of, boy, there's a recession coming. Shouldn't people just sell their portfolio and sit on the sidelines, wait for it to get better?
Yeah, look, that's a great question, Steve. And it's a question that affects all of us, because investing is about being able to deal with uncertainty. And if everything was certain, there would not be returns. You know? The returns would be trivial. But
so what you just said is we need uncertainty to get returns as investors.
You need some level of uncertainty to have returns. Because if someone is telling you, for sure tomorrow you're making $1, the price of that contract, for sure tomorrow you get $1, the price of that contract today is probably $1 or 99.9 cents, because it's for sure. So what you want is, you may get $1 tomorrow on expectations, so suddenly you're not going to pay close to $1. You're saying, well, I'm going to pay you 50 cents because I don't even know. So you're going to lower that price enough until it's a good deal for you. And that's what the market is doing. So if you think about, you say, we may get entering a recession. We may already be in a recession. For that, we just don't know. If you look at the first and second quarter of this year, there was negative GDP growth. We may be. And how you define recession depends on different people define in different ways. But the market probably is already pricing a recession that we may be in or we may be in. So when the market prices go down, it's because the market is saying, uncertainty is coming. Like the insurance company, when my kids start driving, they start charging more. Well, exactly the same. Here, the market is seeing a possibility of recession or recession. The market prices go down and down and down. Why? Because the market is demanding higher rewards to face that risk. So if you look at the performance of the market during recessionary periods, the market performance is negative. If you look at from the beginning of the recession to the end of the recession, the average monthly performance of the market during those periods is negative. Immediately say, let's get out of the market.
Why wouldn't you?
Wait a second. If you get the recessionary periods and look at the very beginning of the recessionary periods, let's say the first half of the recessionary period, the performance of that first half is extremely negative. The second half of the recessionary period, the performance is very, very positive. Great performance. So when we are sitting today, after seeing the market going the way it has gone, the market probably priced already, in the price, the market already saying, let's go down in prices because a recession is coming. If we leave the market now, we probably miss the second part. And we don't know when the second part is going to be. It may take another 6 months, it may take longer, it may take shorter. We just don't know. But we know that if we leave now and we say we're going to put the money in the bank, we're missing that. And many people seem to be doing that, by the way. You know that if you look at bank deposits, you know how much money is in bank deposits today? $18 trillion is in bank deposits. That's a lot of money. So some people will miss the opportunity because during every recessionary period, pitifully, we see people leaving and not being there for the market coming back.
Right.
And that's why we need to realize that investing is about discipline. Not trying to speculate and saying, we're going to be in at the right time. Because no one knows the right time. We know the right time after the fact.
Yes.
And so let's be disciplined, let's invest. And if we look at the performance of the market, since we have data in the early 1920s, it has been super positive. You see growth of the dollar charts up and up and up. And if we over print, so print on top of the growth of the dollar, all the times that the markets have gone down 5%, 10%, 20%, we're going to see a humongous amount of lines saying, despite the market going up, we see a lot of times that the market, a lot, is just full of this market going down 5, 10, 20%. And I always think about this as driving. Look, I'm here in IFA in Orange County. I live in Los Angeles. I need to go from here to Los Angeles. And you don't know what is driving in the 405 or the 5 freeway. A humongous amount of traffic. And I really don't like traffic. What I'm going to do? Not go home because there is traffic? Or saying, despite the traffic, I'm going to get home.
You could take a helicopter.
It's a risk return, you know. The risk is higher, the price is higher. But despite the traffic, we take the journey. Yeah. I get home. And if I think about investment, it's despite the market downturns, I trust the market. I've seen the growth of the market during different periods, long periods of time, and I want that growth. So better if I get accustomed to these downturns because it's part of investing.
So are you telling me Avantis doesn't have a crystal ball and can tell us when the market downturns are going to happen so you can take investors' money out of the markets?
Look, here is the crystal ball. No one has that crystal ball. Yes, if you could predict the future, yes, it will be amazing. Yeah. But if you could predict the future, and everyone else can predict the future, probably we're not going to have high expected returns. The future will be happening right here, right now, and we don't have the returns. So, look, the market is giving us the opportunity to embrace risk, to embrace uncertainty in order to grow our money. As long as we do it prudently, and we do it with reasonable fees, and we consider taxation, and we do it in a diversified way, and we do it based on financial science supporting what we do, expectations are on our side. And that's the best we can do. And be responsible in the investment, not take risks that we shouldn't take. Know our risk tolerance, because you don't want to discover that you have the wrong risk tolerance when the market is down. You want to discover before and have the right portfolio, so even when the market goes down, you can sleep comfortably. Not happy, but comfortably. And so I think that's the value that you guys have to your clients.
I think that goes back to investors having the proper exposure to risk so that when the volatile times happen, they're not happy because it's volatility. No one's happy with that, but they're able to withstand it. To your point, hold on so they can take advantage of when the markets do turn around and go up.
And the markets turn around very fast. So remember, I told you, on the second part of the recession, you are not out of the recession yet, but on the second part of the recession, the market recovers very, very fast. And why? Because the market is pricing things in anticipation. You are not out of the recession, but there is light at the end of the tunnel. And that light at the end of the tunnel, the market acts and recovers. And by the way, in the second part of recession, volatility is huge. A lot of ups and downs because there is uncertainty. But returns are good. So you can have good returns despite the high volatility. And being disciplined is the only thing that you can do. You have been in business like me for a long time. And every time that the market starts recovering, you hear the news, you hear the pundits, I think they say, saying, there's going to be a double dip. It's recovering, but it's a dead recovery, and all the things. I said, imagine if those people have so much information. It will be amazing. I think I have to just tell some story, be disciplined. And as you say when you started to say, we are here at IFA to just have education to overcome speculation. Yes. And so if you're investing just based on just random calls, that's probably speculation. If you bring education, discipline, and an investment process, that's investing.
The process word is very, very good to bring up. I want to summarize a little bit what I think I heard you say, and that is that prices in markets for securities adjust so that the investor gets the expected return. Would you agree with that statement?
Absolutely, absolutely. So imagine, this is simple at the end of the day. Imagine that you think that the company that you have is not going to make $10 in earnings, it's going to make $5 in earnings. What do you think that the price of that security will go? It has to go down. because who is going to pay the same that it was going to pay before? Let's suppose that you're in a time of high uncertainty, that you don't know if it's going to be 10, 5, or 15. Yeah? It's a lot of uncertainty, a lot of variability. Well, you're going to lower the price because of the uncertainty. And so your expected returns are going up when you're lowering the price. And so the market reacts very, very fast. Remember, the market is a combination of a lot of people that are doing free transactions. They're getting into those securities and other securities without any imposition, without any regulation. And if they're doing that, they're doing it because they think that it's a good business for them. And so if it's a good business for them, the price will adjust in order to have a reasonable expected returns given the circumstances. And in times of higher uncertainty, that reasonable expected return probably is higher.
And if you look at the data, if I'm not mistaken, the monthly expected return of the U.S. market is about 1% a month.
Yes.
So if the expected return is 1% a month, would you agree that now is always the best time to invest?
Yeah, 1% a month is a good number no matter what. But you know, if we're going to speak in numbers, I'm always trying not to say numbers because having numbers without a chart is difficult. But if you look, the average return of the U.S. market during a recession is not 1% a month, it's minus 0.2%, somewhere like that, so negative, minus 0.2%. Now, if you look at the first part of recession, it's like minus 2% a month. If you look at the second part of the recession, it's plus 2% a month. So twice the double of the average. Yeah? And so what it's telling you is what I told you. The market price every uncertainty, every recession very, very fast at the beginning. And when there is light at the end of the tunnel, the market is recovering very fast.
Yes. Well, and at IFA, we like to remind investors that you go through a volatility period like we've gone through so far this year. Who knows what tomorrow brings, but it's been extremely volatile. And we hear a lot of, oh, the market's selling off, the market's selling off. I like to remind investors, in order to sell, there has to be a buyer.
Yes.
So every day, trades get settled on the sell and buy side. So for every seller, there's always a buyer. So somebody thinks that they're going to get their expected return going forward, or they wouldn't be buying.
Yeah. Look, if you remember, during February and March 2020, when the pandemic was at full swing, yes, and many people suffered, so we're very sad about that, but the market went down a lot.
In a very short amount of time.
In a very short amount of time, the market went down a lot. And a lot of people left the market. If you look at the week of March 23rd, 2020, so if you remember, that's a week that the market got to the bottom. $365 billion got into government money market funds. So people that say, I'm done, out. I cannot deal with this anymore. I'm predicting catastrophe in the future, so I'm out. $365 billion is a lot of money for people just bailing out.
Yes.
And the sad thing, the market for them, the sad thing is they have the opportunity cost. The market recovered, and probably they were not there. And I'm sure that your investors didn't have that experience because you have education and said, these things happen. Markets downturn are part of investing. And you have to have the discipline to deal with those market downturns because you hope for the recoveries at the end. And if not, you just lock in the market downturn and you don't have the recovery.
This came up, we did our quarterly review call here recently with our clients. And I made the point on the call, and I'd like to make it again, that we expect market volatility, and it's a healthy part of how markets operate. Mm-hmm. Personally, in my career, I get most nervous if we've had a number of years of markets having gone up, because I know at some point they have to correct to stay healthy. They can't go up forever. And I think that's a hard concept sometimes for investors to understand, that volatility and markets having sold off is a good thing for the health of the market. It's not fun to look at your statement and see the values of your investments down, but we have to have that. That's how markets operate. And it's important to understand that.
You know, you're speaking about volatility, and this probably is a message to all of us, you, me, our families, and your viewers. Volatility will be high. When volatility spikes and goes up, it stays high. And so even the market may start recovering, volatility will continue to be high. It takes a long time for volatility to calm down. And why? Think about that. When you get shocked by something, your blood pressure goes up. It takes a while to come down. Your anxiety goes up. It takes a while to go down. Think the same about the market.
Yeah.
There is uncertainty, and so volatility spikes. News come in and out, and market reacts a lot to news coming in and out, one direction or the other. And so we are going to have a lot of volatility, and it's going to continue. You threw a rock in the pond, the rock is already gone, but the waves keep on going for a while, and then at some point they dissipate. But it takes a while. The same, we are going to have volatility. Volatility will stay for us for a while.
Well, that's part of why we emphasize education at IFA, so that we can keep that blood pressure down. 'Cause
Yep.
we understand that it's not fun, again, to see markets that have gone down, but it's going to happen. We just
It's
don't know
sad.
when, and we don't know for how long, but
Yeah.
education should help with that. Eduardo, this has been fun. Thank you very much. We appreciate you coming in, and hopefully we can do this again soon.
Whenever you want, you know. I live close by, despite the traffic, I live close by, 1 hour away. But Wes, thank you very much, and the whole team, thank you very much.
Thank you. And thank you, everyone, for tuning in. We'll see you next time.